Today we are diving into the heart of accounting, the journal, where every financial story gets told twice. Why does this matter? Because proper journal entries are like the DNA of the financial statements. If you mess these up, and everything that follows turns into a financial horror story. ಜರ್ನಲ್ ಎಂಟ್ರಿ ತುಂಬಾ ಇಂಪಾರ್ಟೆಂಟ್ ಆಗುತ್ತೆ. ನೀವು ಜರ್ನಲ್ ಎಂಟ್ರಿ ಮಿಸ್ಟೇಕ್ಸ್ ಮಾಡಿದ್ರೆ ನಿಮ್ದು ಎಂಟೈರ್ ಫಿನಾನ್ಷಿಯಲ್ ಸ್ಟೇಟ್ಮೆಂಟ್ಸ್ ವಿಲ್ ಗಾನ್ ಫಾರ್ ಅ ಟಾಸ್. A journal is your business's financial diary, the very first place where transactions get recorded. It's the book of original entry. Sounds fancy, right? It just means this is where the financial tea gets spilled first. Every entry is dated and recorded chronologically. That's just a fancy way of saying in order of when they happened. No time machines allowed in accounting. ಅಂದರೆ ಟ್ರಾನ್ಸಾಕ್ಷನ್ಸ್ ಆದಂಗೆ ಇನ್ ದ ಆರ್ಡರ್ ಆಫ್ ಹ್ಯಾಪನಿಂಗ್ ಯಾವಾಗ ಆಗುತ್ತೆ ಆವಾಗ ನಾವು ಅದನ್ನು ರೆಕಾರ್ಡ್ ಮಾಡ್ತೀವಿ ಕ್ರೊನಾಲಜಿಕಲಿ. The format is pretty straightforward. The date, particulars, the ledger folio, debit and credit column. See, date is what the recording of when this financial drama occurred. And in the particulars column, we write the accounts involved in the transaction. And the ledger folio is basically the page number where this entry will later appear in the ledger. It's like see page 5 for more gossip kind of thing. And debit and credit is the amount that we record as per the dual aspect concept, as you have learned in previous videos. And don't forget the narration. It's like adding a caption to a financial selfie to explain what has happened. Now, for the $1 million question, how do you know what to debit and what to credit? We have actually two approaches for this, traditional approach and modern approach. In this part, we will be discussing the traditional approach, and in the next video, we will be discussing on the modern approach. So, let us start understanding the traditional approach. Did you know accounts have family trees too? Welcome to the accountingancestry.com, where we are about to discover how the traditional approach sorts every account into its perfect accounting family. If accounts were invited to a family reunion, they would organize themselves into 3 distinct family lines: personal account, real account, and nominal account. This traditional classification system has been helping accountants sort their financial chaos since before calculators were cool. This traditional approach might seem old school in our modern accounting world, but trust me, understanding this ancient classification will save you in exams and give you accounting superpowers in the real world. Let's break down these 3 accounting families and their quirky relatives. Those are accounts related to persons or entities that the business deals with. Think of them as the who's who of accounting. They come in 3 fashionable varieties: natural person, artificial person, and representative person. Natural persons are actual humans with accounting relationship like Raj, Amir, Priya, who always in an actual human or natural person. And second one is artificial person. These are legal entities created by humans but without actual birthday parties. Companies like TCS, Infosys, banks, clubs, they may not breathe, but they certainly have financial lives. And the third one is representative personal. These accounts represent a person but don't directly name them, such as outstanding salary, prepaid insurance, and capital. Basically, these accounts are actually represented by employees or owner, as the case may be. So let's understand the golden rules for personal account. It is beautifully simple that debit the receiver, credit the giver. When someone receives something from your business, you debit them. When someone gives something to your business, you credit them. This is the rule. And the second type is real accounts. No, these aren't accounts that exist while others are imaginary. Real accounts deal with assets and properties, things you can typically touch, feel, or at least take a screenshot of. They come in a stylish varieties called tangible and intangible. Tangible are like buildings, computers, vehicles, cash, inventory, whereas intangibles are like patents, goodwill, trademarks. The golden rule for real account is debit what comes in and credit what goes out. When an asset enters your business, debit it. When it leaves, credit it. Simple as that. And the last part is nominal account. Last but not least, they are the dramatic actors of accounting that live for one accounting period and then reset. Think of these as the one season wonders of your accounting show. These accounts track expenses, incomes, losses, and gains, especially measuring your business performance. And the golden rule for nominal account is debit all expenses and losses and credit incomes and gains. When money flows out as an expense, debit that account. When money flows in as an income, credit that account. To sum up the account classification, personal account rule says debit the receiver, credit the giver. Real account rule says debit what comes in, credit what goes out. Nominal account says debit expenses and losses, credit incomes and gains. You can also think of it as three simple questions. Is it a personal or entity? It is personal account. Is it a thing you own? A real account. Is it about earning or spending? It is nominal account. Students, master this particular traditional classification and you will have the foundation for understanding any accounting system in the world. So in our next video, we will be discussing on the modern approach.